Hello candidates, and welcome once again to the topic equity market equilibrium. In our last session, we defined equities, we defined equity market. Today we want to understand the concept equity market equilibrium. Equity market equilibrium. Candidates, the actual market price of a stock must equal its intrinsic value. What did I say? I've just said that the actual market price, must equal the actual intrinsic price, or what we call the fundamental price, the fundamental value of a stock. And candidates, or I can say, in equilibrium, the actual market price of a stock must equal its intrinsic value as estimated by the marginal investor. Okay? As is estimated by the marginal investor. In other words, candidates, I've just said P naught, which stands for the market price, should be equal to P, which stands for the intrinsic price. Intrinsic price. And candidates, if the actual price is lower than the fundamental value or the intrinsic value, then the stock is a bargain. The stock is what? The stock is a bargain if the actual price is lower than the fundamental value. If the actual price is lower than the fundamental value, then the price is a bargain. The price is a bargain. And therefore, buyers or buy orders will exceed sell orders, where the actual price is lower than the fundamental value. The price is a bargain, leading to buy orders exceeding the sell orders. Okay, buy orders will do what? Will exceed the sell orders. And the actual price is said to be a bid up. Okay, in that case, the actual price will be a bid up. And the opposite will occur if the actual price is higher, candidates, than the fundamental value. Will have the contrast. And candidates, in other words, in equilibrium, expected returns must equal required returns. In equilibrium, expected returns must equal required returns. Expected returns must equal required returns. Expected returns must equal required return. Must equal required return. And we know, candidates, that expected returns is or should be equal to D 1 over P naught plus the growth rate, expected DPS over the market price of a dividend plus the growth rate. And if you are using CAPM, the return will be equal to risk-free rate, the risk-free rate plus the difference between the market return and the risk-free rate times the beta of equity. So it's important to understand that point. Now, candidates, if expected return is greater than the required return, then P naught, then the market price is lower or is too low. Candidates, if the price is lower than the fundamental value, then the stock is a bargain. That's what we had seen here. It is a bargain. And we say that the buy orders will exceed the sell orders. And we say the price will be a bid up until it will be a bid up until expected return is equal to the required return. And the state of the market candidate results from the conflict between the choices made by all those acting in it. And equilibrium is reached when the supply of each security is equal to the demand for each security. And this is how the evaluation function will be determined. And you need to remember that this function is applicable to all securities simultaneously in a given market. And although equilibrium may only be calculated in detail by imposing the condition of equality of demand and supply for each security, it is possible to state a minimum condition, which is necessary but not a sufficient condition, which must prevail at equilibrium and which may on its own, in certain cases, provide valuation results. And if you've been studying well, candidates, this condition is this is just a condition which is in the absence of the arbitrage opportunities. It is the absence of arbitrage opportunities. Arbitrage. Candidates arbitrage is just an operation which generates a positive profit with no outlay of capital and no risk taking. For example, if there exists on the same market two identical securities at different prices, it is obvious that each investor would choose to buy the less expensive security and sell the one whose price is higher. And the difference would provide an immediate profit with no risk and no capital outlay, since the sale of one would have permitted the purchase of the other. And if arbitrage opportunities exist, the market could not be in equilibrium, since all operators would carry out arbitrage operation, demanding some securities in infinite quantities and selling others in equally infinite quantities. And in such conditions, the demand for each security could not be equal to its supply. Is that clear, candidates? And the basic idea according to which a market in equilibrium cannot offer arbitrage opportunities results in a very important principle which characterizes the evaluation function of all markets. And this is the value additivity principle. Value additivity principle. The value additivity principle. What is this principle all about? Candidates, this principle states that when the value of a whole group of assets or securities exactly equals the sum of the values of the individual securities. That's the value additivity principle. So candidates, arbitrage is just an operation which generates positive profit with no outlay of capital and no risk taking. So in short, candidates, that's what we refer to as the equity market equilibrium. Equity market equilibrium. And on that note, we take a break. When we come in our next session, we continue to learn more about the topic equity market equilibrium. We'll be considering different models under the equity market equilibrium. Thank you and God bless you.